Welcome to Crash Concepts, where the economy, energy, and the environment are explored. Up next, fresh ideas and insights into the factors that are driving the world and shaping your future. Presenting information you can't afford to live without, here's Chris Martenson.
Welcome to this Peak Prosperity podcast. I am your host, Chris Martenson, and it is June 14th, 2016. Energy. Specifically, oil and natural gas. These are always front and center on my mind because I'm not confused. The economy is a subset of energy and not the other way around. Either a species has access to surplus energy or it doesn't. If you're a wolf who does not eat enough, you waste away and you eventually die. If an economy does not have surplus energy, it too skinnies down and simplifies. Less energy means less stuff being made, less stuff being produced, and less stuff being transported. Less energy means fewer jobs and fewer opportunities, something that should concern everyone. Now, the common story, or meme, if you will, in the Western press today, is that the world is awash in oil and absolutely overrun with natural gas. While such abundance may be temporarily true from a supply and demand standpoint, it would be a colossal mistake to then project that this abundance will always be true. Yet many make this mistake today. I talk to people all the time who have zero appreciation for the actual state of our dependence on petroleum and natural gas, and no understanding that both are of limited supply and will someday peak and then be entirely exhausted. Okay, so what I'm saying here is that energy is the master resource. And so we have to wonder deeply about what these currently low prices for oil and natural gas are really telling us. Separating the signal from the noise is essential, but never more so than when you are talking about the master resource. To help us make sense of all of this is, by far, my favorite oil analyst and energy specialist out there. Arthur Berman is a geological consultant with 37 years of experience in petroleum exploration and production, with 20 of those years at Amoco, now known as BP. He's published more than 100 articles on geology, technology, and the petroleum industry during the past 5 years. He's got the chops, and he has published more than 20 of those articles and reports on shale plays, including the Barnett, the Haynesville, Fayetteville, Marcellus, Bakken, and Eagleford shales. I follow him very closely at his blog, artberman.com, and you should too. Welcome, Art. It's great to have you back on. Let's dive right back in. You know, I'm reading lots of reports in the Wall Street Journal, other places that say that shale companies could make money at 30 a barrel. Oh no, they're going to come roaring back at 40 a barrel. Well, here we are at $50 a barrel. Has the shale business come roaring back?
If we're talking about a break-even oil price of $30 and you're not talking about royalties and taxes and paying your employees and paying your debt service, well, yeah, you look pretty darn good. But you add in the normal cost of doing business, and now we're talking about a different story. So bottom line, Chris, is that there isn't an oil play in the United States or Canada that can break even at less than $50. And there isn't an oil play in the world, in fact, when you include country overhead, which is to say what a country like Saudi Arabia or Kuwait needs to balance its fiscal budget, which is overhead. There's nobody in the world that can break even at less than $50. And by the way, Kuwait is the cheapest producer. So what we've seen is a situation where not very long ago, 1990s, in the 1990s, oil prices in real dollars, 2016 dollars, were $20. And companies and countries were making money, or enough to stay in business at least, at $20 oil. Okay, and what I'm telling you now is that in less than 20 years, or about 20 years, nobody can stay in business at less than 2.5 times that basic cost. And so the cost of energy, certainly the cost of crude oil, has gone up 2.5 times in 2 decades, and that has absolutely very significant implications for everything that we talk about and think about. And when we read in the press or on television that oil is just getting more and more abundant, well, okay, I'm not going to argue with the abundance issue because that's another argument. But if it costs 2.5 more times to have all this abundance, then what's it really worth? That's an important piece of information to understand.
So let's cover that information in more detail because I think it's vital here. It seems to me that when I look across the landscape, everybody on my listeners are pretty much all familiar with the idea that the amount of capital destruction in the oil business has been absolutely alarming. And lots of people are beginning to understand that today's lack of investment is tomorrow's shortfall. But what you're saying is that even if oil prices went up some, that if I'm interpreting right, the types of oil finds that are left are going to require a much higher price for oil in order to justify them, as you see it, as much as 2.5 times.
That's absolutely correct. Yeah, we're talking about the shale plays. I can give you an optimistic view of them in terms of remaining resources and break even and all that. But as I said, 50 is the cheapest, and really we need to be talking about 60, 65 kind of on average for the best of the plays in the core areas. We've deep water is higher. Oil sands are depending, can be sort of in that range for existing projects, higher, probably 80 for new projects. And I just told you that OPEC, for the most, on average, OPEC needs $80, $85. Some are higher, some are lower. That's the way it always is. So that's the world we live in.
Well, in continuing this world, I keep reading about a lot of disagreement, but let's just say that existing conventional fields are declining at rates of between 3 and 6%, depending on who you're listening to. First, where do you fall on that natural decline rate? And second, it's those natural decline rates that, if I read a Bloomberg report correctly, are going to swamp new online efforts that are coming online from prior investments. Is this a seminal year, with 2016 being that magic crossover point where declines are going to exceed new supply? Is that important? And second, has it happened before?
Well, again, we're talking about overshoot and undershoot, and what is happening right now that at least according to the International Energy Agency has never happened before, is that we've had 2 consecutive years where investment in oil production, infrastructure, exploration is significantly lower than the year before. And we may be going on a 3rd year. So with that in mind, and we're talking about, $500 billion less in 2000, if you take what we're going to spend in 2015 and 16 on these projects versus what we did in 2014. $500 billion. Okay, so that's going to come back and hammer us. It's absolutely going to hammer us because you can't do that. You can't do that in any business, and you certainly can't do it in a capital-intensive, long-term business like we're in. And so it's important to understand that the time from discovery to first oil for big fields in the world has increased tremendously. It's gone from a couple of years, not too many decades ago, to 6 to 10 years on average. And a lot of the biggest fields that have been discovered over the last several decades, Kashagan is the one that comes to mind in the Caspian Sea, 30 billion barrel field, is going on, 15 years between discovery and first production for a million reasons that we don't want to get into, but it's complicated. Okay, you got politics, you got all kinds of people's budgets, you got prices, you got all sorts of issues. So that's the problem, that there are leads and lags that go into this. And so back to your decline rate issue, conventional oil is declining. It's in terminal decline. I mean, nobody is investing in conventional oil projects that move the needle in terms of global supply, which doesn't mean that there aren't important things going on. And I mean, little guys like me, I'm drilling wells, okay, and these could make a lot of money for me and my investors, but not reserves that really matter. So all of the investment that's going on today is in expensive oil. And what I'm telling you is that over the last 2 years, the level of that investment has fallen off a cliff. And just to put it in perspective, a big piece of that investment is in proven reserves, things that we've already discovered, already appraised. The oil's there. We just have to spend the money to drill the wells and put in the platforms or whatever to develop it. 20 billion barrels of production has been deferred because of low prices. This is all going to, so what we're going to have, and I don't want to create any sort of sensationalistic, fears or anything, but I got to tell the truth. The truth is that we're going to see an absolute moonshot in terms of oil prices sometime sooner than later, I think. But let's just say in the next 5 years. And I shudder to imagine the devastating impact that that'll have on the global economy. It's just going to be it's going to be paralyzing.
Well, certainly because people who are unaware of energy have been busy conducting monetary and fiscal policy and goading us all, corporations, households, and governments alike, to get into more and more debt. Different discussion, but let's just say a moonshot in oil prices and well over $200 trillion in debt, not talking unfunded liabilities, just in debt alone, that's going to be a collision that's sort of a Hollywood blockbuster. I want to put this in perspective. Last year, the world pumped out and consumed some 31 billion barrels of liquids. We discovered in new reserves, so this helps to separate what you're saying. Some of that capex went into existing fields known. That doesn't increase the reserve count, but new reserves came online of only 2.8 billion barrels in 2015. So we pumped 31 and we found 2.8 billion new. Now, I'll go a little further. I don't know if this is sensationalizing, Art, but to me, I want to grab people by the lapels and say, your hair should be standing on end. This is a really big deal.
It is a really big deal. There's no question about it. And yet, we are in this state of intoxication at the moment about the fact that the world is drowning in oil and that people can actually make money at $30 or $40. So there's a disconnect, and those who pay attention to your analysis and mine and some other people hopefully understand that and consider that in their how they manage their lives and their investments, because there's just no way that it isn't going to be a factor in the relatively near term.
Absolutely. So to finish out this part on oil, I'm reading a lot about shut-in production in places like Libya, Nigeria, mostly geopolitical reasons. If those came back online, would that help to, not help, would those continue to perpetuate the oversupply issue, or are these just sort of noisy things at the edge of the story?
Oh no, they're fundamental to the story, and so a big part of the resurgence in oil to almost $50, it's a little bit less than that today, has been what we call outages, okay, supply interruptions. And Libya has been a long-standing, I say long-standing, since 2011 or so, when that country got into civil unrest. And so there's 1 million barrels a day, plus or minus, that has been pretty much offline for better part of 5 years. Iran is back online, and they're now producing something like 800,000 barrels of crude oil more per day than they were in December. So that's a plus. Libya's a minus. Nigeria's having all sorts of issues. The government decided it wasn't going to pay off the folks that are now bombing pipelines and disrupting things. I don't know what that's going to be. It's a few 100,000 barrels a day, and then we had these big fires in Canada that have taken another 800,000 barrels offline. That's temporary. But so we've had and there was a big worker strike in Kuwait that for a couple of days took a lot off. So what all that did is it created a wake-up call for those who trade oil, and they said, oh my God, we have this oversupply, but it's fragile, and it is. And a couple of unanticipated events can move the balance very, very quickly. And so one of the phenomena that I've pointed out before is that we've had a couple of years, with the exception of Libya, really, a couple of years where there just haven't been a lot of outages in the world for reasons that I can't imagine. What's happening right now, and Venezuela, by the way, is on the verge of political collapse, and who knows what that's going to do, but it isn't going to be good. What we're seeing right now is kind of more normal. Maybe it's kind of moved to the extreme side of normal, but we had a couple of years with very few supply interruptions, and we coupled that with high prices and low interest rates, and we got the oversupply. So my point, Chris, is that I think that some of the enthusiasm about this latest price rally, if you want to call it that, I'm going to be a little bit more skeptical about its lasting power. And I'll just end with one final comment that there are no straight lines in the real world. And that could not be more true than with oil and natural gas prices, that these things are cyclic. And you look at the price cycles that we've seen just in the last year and a half, and this rally will end, and prices will fall. They probably won't fall as low as they have been previously, but they will go down to some support level, maybe 35, maybe 45. I don't know what it is. It's probably closer to 40 or 45, and then they'll rise. The overall trend, I think, is up, but it isn't going to be a straight line. There's going to be ups and downs, and we're seeing right now another factor. We haven't had a lot of global economic bad news in the last 6 months, and now we're starting to see it resurface, and that's starting to dampen people's enthusiasm for oil price.
Yeah, that's the big asterisk on this story for me, Art, of course, is that if we do get into another capital R recession or capital D depression worldwide, of course, the demand side could easily take prices down. But I will note that we're starting to see reports that many hedge funds and other large money smart players, or so-called sophisticated players, I guess, they're positioning for a steep rise in oil prices 2-3 years out, mainly on the futures chain and using options and things like that. My summary for that would be that I think it would be a mistake for the average individual to not also, in their mind at least, entertain the idea that oil prices could go up a lot and the impact that might have on their life personally, and then more broadly on the economy. But that's not a very commonly held view, and could be wrong. But would you agree that people really ought to be seriously entertaining those sorts of knock-on effects?
Oh, absolutely. So we have the short term, the short to say medium term of a year and a half, in which I think we're going to be on an upward trending roller coaster of oil prices, but upward trending in general. Now, things go terribly wrong with China, particularly. Things go terribly wrong, I don't know, with a Brexit or a Grexit or whatever. I don't think that'll have quite the impact of China, but those are factors that we need to think about. So that's the near to medium term. The longer term is the moonshot, and I just don't see any way that the global economy can withstand a return to even $100 oil prices, much less higher. It always kills the economy And this time around, the economy is so fragile because of debt and just poor performance, underemployment, under participation. It scares me to imagine what the effect of that could be.
I totally agree. So let's reel it down a little more granular. If you have a point of view, I'd love to get your view on the sort of economic damage that's been inflicted on places like North Dakota during this rundown in oil prices. I mean, I'm looking right now at only 25 active drill rigs here on the June 14th report of 2016. And then same date a year prior, there were 187 drill rigs operating. That's an 85% decline in drill rigs. That's a lot of activity that's not taking place. That's got to be hurting.
Oh, it is. And we heard all kinds of sophisticated economists early on in this price collapse talk about how this was going to be a net benefit for the global economy. I don't think that's exactly worked out the way that they thought. And the reason for that is I think that they failed to recognize just exactly what proportion of global capex, global GDP, energy has become. And so, sure, it's great that it doesn't cost us as much to fill up our cars and et cetera, but and that is a benefit for the consumer. On the other hand, you talk about North Dakota, imagine entire countries like Nigeria, Venezuela, Russia to some extent, Angola. I mean, these are entire countries where consumers' ability to survive and to buy goods and services is largely dependent on revenue from oil companies and service companies spending money, paying salaries, and that isn't happening. And part of the reason that we're seeing so much political unrest in places like Nigeria, Venezuela today are because not only are oil prices low, but spending is low, and therefore people aren't making any money. So, yeah, and I see it in Texas. Texas is probably as bad as North Dakota, that it's not just the drilling rigs. It's it's all the associated things, the people who drive cars and trucks, who stay in hotels, restaurants, have their cars fixed, need their houses or their apartments or their trailers serviced. I mean, all of that, the amount of spending goes way down, and that's difficult for those local economies.
Absolutely. And speaking of Texas, let's turn our attention now in the time we have left to gas. I loved your recent data-filled piece entitled Shale Gas, Magical Thinking, and the Reality of Low Gas Prices, found right at artberman.com. Of course, Art, you had me right from the opening two sentences, which were, I'll quote here, "Enthusiasts believe that shale gas is simultaneously cheap, abundant, and profitable, thus defying all rules of business and economics. That is magical thinking." What's magical about that thinking?
Well, it just sounds so good, doesn't it?
It does. Cheap, abundant, and profitable. Lovely.
You got to love it. It's it's back to the nursery. But that's just not the way things work in the world. And the piece that's absent from those kind of people's thinking is, and it's all funded by debt. You can carry on pretending like you're making money because you continue to drill and produce as long as somebody keeps giving you money. What happens when they stop? I mean, this is Wile E. Coyote all over again. He can run out over the Grand Canyon and keep on moving until he looks down and realizes he's not on solid ground, and then of course he crashes and burns. And that's exactly what we're seeing with shale gas. Shale gas has been a marginal business at best for all of the years I've been looking at it, and I have my share of critics who constantly point out, well, you were wrong. You've been wrong all along. And I don't mind being wrong because I get more information and I'm going to change my opinion. I'm not a politician. Flip-flops are okay for a scientist if data says you got to change your mind. And to me, that's just intellectual honesty. But the thing I've been most wrong about was the longevity of shale gas companies' ability to keep getting money and therefore to continue running themselves into the ground on unprofitable ventures. I completely blew that. I just couldn't imagine that could go on as long as it has, and I was wrong.
Yes. So you keep, in this article, you keep posting these very damning tables of the actual break-even costs for these shale companies, not just being a little bit higher than the current price of gas, but sometimes as much as 100% or even 200% higher. First, how do you arrive at such calculations? And then second, with hindsight, how is it that you and I have been so both wrong at how long they've been able to keep this magical fantasy going? So first, the break-evens. Why are yours so out of alignment with what the industry says?
I think it's pretty simple, and I've done this long enough, and I have an engineer colleague that works with me. I mean, we've been over and over plays like the Barnett and the Fayetteville and the Haynesville and the Marcellus since go. And yeah, it's fine if maybe you don't have enough information in 2008 or 2009 to predict exactly how things are going to work out as far as reserves and everything, but now we do. So how does that work? Well, we start with the basics. We look at what wells are probably going to produce, their estimated ultimate recovery, and we do that through a very standard process that has a certain amount of uncertainty, if that's a correct sentence. Mm-hmm. But over time, you get more confidence with more production history. So one place where you get a big disconnect is that I don't know where the analysts that talk about shale gas breaking even at $2 or where, I don't know where they get their reserve numbers. But they must get them from a really different place than where we get them, and I feel we're pretty confident that we're right within 15 or 20%. So if you got a really big reserve number, well, your economics work out very favorably because you got a big number to that's creating revenue. So that's one half of the story, and the other half of the story is cost. What does it cost you to do business? And as I said early in this discussion, if you exclude a bunch of costs, then you come up with a much lower break even. And by the way, we don't include land costs anymore. We should, and we'd like to, but we just finally gave up on that. Okay, we don't want to be that far out of calibration with the rest of the industry. They've written those costs down a long time ago, so fine. But basic costs of doing business, like paying your employees. If you don't have another profit center other than the well, then it's got to come back to the well. So we look at the costs, and where do we get the costs? The companies are required to disclose them to the Securities and Exchange Commission every quarter. So we don't make up the costs; we get the costs from the companies, and I assume they're right, or else they could go to jail. So you take the costs, you take the reserves, and you take the price, and you can run different price scenarios, and then it's just basic economics. I mean, there's nothing magic. There's nothing complicated here at all.
Now, in this same report, you also have a nice chart, and it shows that out of all the shale gas fields you're tracking, only one of them is producing more gas today than it was in a prior period, leaving all the rest of the plays, of which I didn't even count them. Was there a dozen or more? They're all producing less than they used to. Is this post-peak of production, is that an economic peak or a geologic peak that's been experienced?
Well, it's a bit of both. And so the first shale gas play, the Barnett Shale, which is in north central Texas, and the second, the Fayetteville, which is just up the road in Arkansas, basically the same rocks. Those were plays that were supposed to last, 50 or 100 years, and here we are a decade into their production, and there are 0 rigs in the Fayetteville, and there are 0 rigs in the Barnett. Does that mean that they've reached full development? No. But at current gas prices, and by the way, at much higher gas prices, our estimates say, you need something like at least $5 or $6 gas before additional drilling makes any sense. So we haven't produced all the gas, but we've produced all the gas that makes any sense, even to companies that get free money to keep on going at anything close to the prices that we have today. And companies are, as one of my friends says, they're voting with their feet. So if they have a choice of spending money to drill a well in the Barnett versus drilling a well in the Marcellus, and they have a position in the Marcellus, they're gonna put the money there every day of the week because the break-even price is lower, the cash flow is higher. So they're not gonna drill the Barnett. So the United States has got a ton of gas. I mean, I don't want anybody to come away from what I say or what they read from what I write, thinking that I'm saying that the resources aren't there. The resources are large. Not as large as the enthusiasts want you to believe, but they're quite large. The problem is what you can reasonably drill and produce at anything close to what realistic prices might be.
Well, now speaking of large, I noted that the EIA just recently came out in a shale basin in Colorado and said, there's maybe, we're going to have to up our estimate by tenfold higher than we thought. They announced 66 trillion cubic feet there for the taking in this basin in Colorado. Doesn't this massive reassessment support that view of the enthusiast that says, well, we'll just keep finding more and more forever?
No, because that's a resource. Okay, there's an important distinction between a resource and a reserve. A reserve is a volume that can be commercially produced at a price, at today's price. A resource is a volume that can be technically produced if you don't care about price. So they're very, very different. And I point out that the only thing that's the same are the first three letters. They both start with RES. And so the EIA is talking about what they call a technically recoverable resource. And that's, people should just ignore that number. That's like saying, well, if I eat well and get the right medicine, I can grow to be 7 feet tall and live to be 150. Well, nobody does, or very few people do. So forget that idea. Let's stick with something that actually can be commercially produced. That's a reserve, and those numbers are, as I said, large, and anybody can find what those numbers are. They're available on the EIA's website, and I recently just did an evaluation. There's a group out of Philadelphia called A Pipeline for the Future, and in their executive summary, they say that there are centuries of reserves in the Marcellus and Utica shale plays at current production rates. Well, that's just absolutely untrue. I mean, you take what the EIA shows for reserves, even including undeveloped reserves, and you add those up and you divide by current production rates and you end up with 20 years. Well, I mean, 20 years is a lot of gas, don't get me wrong, but centuries? How do you get from centuries to 20 years when all you do is go online and look at a number, look at two numbers, a reserve and a production rate? That's not Art Berman's interpretation. I mean, that's data. Okay, so that's the background.
Well, speaking of those cheerleaders, so close to my final question, I notice here that U.S. companies are still building massive new facilities, electrical production and industrial uses that will use gas, while gas producers themselves, they're scrambling to figure out how to export more of it as quickly as possible. So let me ask you this. There are a lot of very intelligent people involved in these projects, a huge amount of capital. Well, what could possibly go wrong?
Well, everything has gone wrong. That's the problem. This was there were all kinds of misbegotten efforts over the last 10 years to try to increase U.S. consumption. Let's have natural gas powered cars. Let's export more gas. Let's do all this stuff. And the truth and the reality is that the only growth area for natural gas consumption is in electric power generation. And all the rest have kind of fallen by the wayside. Gas-powered cars I won't say they're a bad idea, but there are a lot of problems with getting, well, people just haven't bought into it. Let's just leave it at that. Gas export you hear an awful lot of, furor about that, but the truth is that we're not exporting hardly any natural gas right now, except by pipeline to Mexico and a little bit to Canada. But by the liquefied natural gas, very, very tiny volumes. And looking out to say 2020 or whatever, maybe 5 or 6 BCF a day, billion cubic feet of gas a day, compared with what we produce right now, which is about 75 or so of dry gas. It's not nothing, but it's a relatively small percentage. So the problem is that we're just not consuming enough to compensate for the grotesque level of overproduction. The result, therefore, is crushingly low gas prices that are now starting to show up in a very negative way in everybody's balance sheets, and companies are going bankrupt. They're in serious trouble, all of them.
Well, now that brings me to my final question, which is that let's say that someone listening agrees with us that oil and gas have to go up in price at some point, but there's all these hidden crushing landmines of poor economic performance out there. What's the right way for an average investor to go about investing in this space?
Carefully. There's a lot of risk because of all the things we've been talking about here for the last 50 minutes. So it's important to you want to listen to Kramer, or you want to read what people write in the Wall Street Journal. Fine. Go ahead and do it, but you really need somebody guiding your investments that has a better understanding of all the uncertainties and the big picture involved. Now, having said that, I'm on record as saying that I think natural gas is the more attractive of the two commodities as an investment. And I've been, saying this for some time, and just in the last couple of weeks, the price of gas has gone up, dramatically, and that in spite of the fact that we still have a very large overhang of storage. And what's the reason for that? Well, markets. I won't say markets are smart because I don't know who markets are, but markets are fairly good at anticipating what's coming in the future, and the gas market right now, and there are people that are thinking about this. They're saying, "Oh my gosh!" You look at the additions to gas storage compared with a year ago, or compared with the average, and they're puny, and so we see that there's going to be a supply deficit down the road. And oh, by the way, all of this export of pipeline gas to Mexico and Canada and LNG export is contributing to that. So and so some of that is due to lack of investment because of low price. And shale gas, which is the only growth in U.S. gas supply, has rolled over. Okay, at best it's flat, and I say that just because it's a moving target that changes monthly, but it's not growing. And conventional gas is like conventional oil. It's in terminal decline. So there's a convergence that's on us right now in the U.S. with natural gas because it isn't a global commodity. We can't import it from Saudi Arabia or wherever. Natural gas prices are going up because the market anticipates that we're not going to be able to keep up with demand, and that's the bottom line. So I see, and I've written about this. I think gas prices could easily be $3 by the end of the year, and could be $4 a year from now. Now that's still below the break-even price for most of these plays, but for an investor, if you got a company that looks reasonably attractive at $2 gas, then they got to look great at 3, right?
Well, that's the hope. And of course, the easy part of this is buying into a commodity play when it's below the cost of production. That's the easy part. The hard part, as you've articulated, is that some of these companies have already stepped on their own personal economic landmines. And so you have to dig through, because some of these companies deployed capital when prices were far higher. Those wells have already gone into their decline phase. So that capital has already been betrayed. Trying to detangle all of that and figure out who's upside down on the debt bandwagon is not always an easy task. But I agree. I think there's a no-brainer component of this, which is things have to get back up to at least the marginal cost of production. That's going to create some winners. But boy, teasing out the losers is take something other than your usual Wall Street cheerleader analyst to help you untangle. So pick carefully and do your due diligence, or find somebody you can trust. That would be my advice. But I agree, there's some great investments to be had here. So with that, thank you so much for your time today, Art. As always, I can hardly wait to have you back on. Today was so good. It's been a real pleasure speaking with you.
Always fun to talk to you, Chris. Thanks a lot.
We've been talking with Art Berman. His website is artberman.com. You should read it. And this is Chris Martenson signing off.